then think about where the markets are, start the clock, and think about the markets. I mean, you've been through where we are on some of these Russian assets overnight. It's interesting to see that we're actually, we've been weaker on the Russian ruble. So if you were to look at the lens of tension through the markets, you might say, well, we're kind of over the worst. But of course, the Russian ruble reacts to the oil price as well, I suppose.
Yeah, very much so. And actually, the Russian ruble is well up from the lows of a couple of weeks ago. You've got to remember that the story around the Russian ruble has always been a sluggish economic story in Russia. So if you're a bull on the Russian ruble, you're playing it because of the massively positive real yields, the fact the country has a low debt pile, and now you've got the support of a terms of trade story because of those high oil prices. Now, those high oil prices were the other side of the coin of the geopolitical tensions. But if we get an easing of geopolitical tensions, well, then you're just left with a very, very strong story. It doesn't matter that their economy is not doing very well, because that was never part of the argument.
Yeah, so if oil prices are held up by other factors, and certainly some voices tell us that they are, as well as the geopolitics, then that remains in play. Let me ask you about China and the data we had out there. We've talked about the UK CPI, we've talked about US PPI. We got both of those data points from China, both still at elevated levels, but crucially easing. And is this telling us something that's a different dynamic to the rest of the world and leaves the way open for the PBOC, the central bank, to take a different course to certain Western economies?
Yeah, I think this is really important. We know that the Fed PBOC policy divergence is one of the big themes that we're kind of focused on in 2022 and how that will play out in assets. And this kind of emphasizes the story yet again, because it came just after PPI inflation in the US came out so strong again, and we've just seen the UK inflation again. So therefore, this does open up the PBOC to ease a little bit more aggressively at the margin. They don't want to get carried away, but that will continue to support the idea that greater China equities can probably outperform this year, can probably do quite well, and that's where you might see some of the strength. The extra point to note is that generally China, as the manufacturing base of the world, has been seen as a good lead indicator for the rest of the world's inflation. I'm slightly worried that that link may be broken, because the inflation spiral in the US has now gone on long enough that it's transitioning to services and not goods. Services making up about 60% of the CPI basket versus goods about 40% of the CPI basket. So the relief in inflation in China is not such good news as it would have been 6 months ago for the US assets.
OK, that's interesting. The link between China and the rest of the world also always worth exploring. Let me ask you briefly then, Mark, about the yield story. Clearly, the Fed very much in the driving seat on that one over recent weeks, but fear also plays a role here. So where does that leave us as the 10-year yield hovers around 2%?
I think in the very short term, we could probably see a little bit of respite for bond markets because we got the Fed minutes coming out tonight. So I expect bonds to do a little bit better, maybe in the short term, yields to come down a little bit. But overall, longer term this year, I expect yields still to go an awful lot lower overall.
OK, remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLIV GO, that is the function to use on your terminal.